Okay, here we are, section 4. So we want to talk about what the international monetary system looks like today and how central banks make a decision here between fixing their exchange rate and floating their exchange rate and the trade-offs that they have to weigh in making this decision. So the best way to kind of visualize this is by looking at this big fancy triangle here, often referred to as the policy trilemma, all right? The policy trilemma is, in this triangle, is really kind of a way to visualize the choices that a central bank has to choose from. In reality, a central bank would like to choose three things. They'd like to achieve three things at one time. Most central banks would love to have fixed exchange rates because that makes trade easier and helps you attract more foreign capital. But they would also like to have independent monetary policy, meaning they would like to be able to set interest rates wherever they want, or control their inflation rate, or engage in stabilization policy. So they'd like to be able to change monetary policy as they want. And then finally, central banks would love to have free capital mobility, meaning they'd love to have capital come in and out of their country because that makes it more attractive, right? You can't make it difficult for capital to leave without discouraging capital that comes in. So free capital mobility is a way to attract more capital. So central banks would love to achieve these three things. They'd love to have fixed exchange rates and independent monetary policy and capital mobility. The problem is you can't have all three of those things. You can't, because they're not consistent with each other. You can have two of those three. So in other words, you have to pick a side here of the triangle. You have to pick a side. You have to decide which two of these things you want to try to achieve. Okay, so let's talk about three examples here of different countries that have picked different sides of the triangle. The first side here, we'll call this the United States, right? Or maybe a better example would be Europe, okay, for reasons I'm going to talk about here in a minute. So, but we'll use the books here, the example of the United States. What does the United States, what have they chosen? We have chosen to have independent monetary policy, right? We want the ability to control interest rates and increase the money supply up and down based on stabilization policy or financial stability or promoting employment or stimulating growth. Whatever our goal of monetary policy is, we want the flexibility to pursue that. We also, though, of course, want capital mobility, right? Because we want to attract a lot of capital. And so to do that, we need to make sure that capital can move in and out. What can't we have? We cannot have a fixed exchange rate then, right? Because if you think about this, if the Fed was raising interest rates up and down and we had capital mobility, what would that mean? Well, really what that would mean is that our exchange rate would be moving up and down too, right? There's no way that you can have capital mobility and independent monetary policy and a fixed exchange rate, right? Because if you have capital mobility and an independent monetary policy, when interest rates move up and down, it's going to force the exchange rate to move up and down. There's no way you can keep all of these three things at one time. So the US essentially has picked the bottom side of this triangle. What about a country like, your book chooses Hong Kong, but maybe we could think about a country like South Korea, right? Well, for these countries, they have picked the fixed exchange rate system, right? They have said, listen, we want capital mobility because we want to attract capital, but we also want to have a fixed exchange rate. Well, what does that mean? That means that we cannot be changing interest rates willy-nilly or changing the money supply. Our sole focus of money supply has to be fixing the exchange rate in ways that we talked about just back here, right? So when the exchange rate becomes overvalued, we need to cut the money supply. When the exchange rate becomes undervalued, we need to raise the money supply. Notice here that monetary policy only becomes about exchange rates. You cannot be thinking about interest rates or stabilization policy or anything else, right? So what are you giving up when you fix the exchange rate and have free capital mobility, you no longer have independent monetary policy, right? You no longer have independent monetary policy. So, really, you kind of see here the advantages and disadvantages of fixing exchange rate for a country like Hong Kong or South Korea, right? The advantages of fixing your exchange rate is, yeah, it helps keep international trade, reduce the cost of trade, right? Because everybody knows what your exchange rate's going to be. It reduces uncertainty, and it helps increase capital flows because it makes it a more attractive place to invest if investors don't have to worry as much about exchange rate risk. Interestingly enough, I talked about South Korea, but South Korea fixes to the US dollar, not the Japanese yen, even though the Japanese yen is Japan is South Korea's biggest trading partner. What does this tell us? This tells us that South Korea is more interested in attracting capital flows than they are about international trade, right? If they were most worried about trade, they'd be fixing to the yen, their biggest trade partner. But they don't. They fix to the dollar, meaning that they're worried about capital flows because most capital flows take place in the US dollars. So that's the advantage of fixing, right? It basically reduces uncertainty and facilitates trade and capital flows. But what are the disadvantages? You lose control over independent monetary policy. So you can't conduct stabilization policy or manage output or inflation or interest rates. If your exchange rate gets too overvalued, you could have a currency crisis and a debt crisis and a banking crisis, right? And we talked about that a minute ago, how letting your exchange rate get overvalued can lead to a crisis. It can also lead to moral hazard and currency mismatch. What does this mean? This means if investors stop thinking about exchange rate risk, right, and stop incorporating that into their analysis, then what does that mean is that if you ever do suffer a currency crisis, it means that they have not paid enough attention in protecting themselves from the downside of risk. So let me give you an example of this. Let's say that you have a bank in an emerging market economy who says, yeah, sure, the government will fix the exchange rate. I'm not going to worry about it. And so this bank goes out and they borrow a whole bunch of money in dollars. And then how do they pay for those dollars? Well, they pay for those dollars by hoping their assets, which are tied to the domestic currency, perform well. But what happens if there's a big fall in the value of the dollar? A big fall in the value of their currency relative to the dollar. And that means that all of their assets become less valuable, but all of the debt that is in dollars has gone up. That's what we call currency mismatch. When you borrow in dollars, but your assets are in the local currency. And, that's really moral hazard. That's taking a lot of risk. And they might be taking this risk because they assume, oh yeah, the government will fix the exchange rate. I'm not going to worry about it. But, currency crises happen. And sometimes governments change the exchange rate, and it can then trigger a banking crisis, a debt crisis, and all that other horrible stuff that we've talked about here over the last couple of weeks. Another cost of fixing is it really forces your central bank to hold billions of dollars of foreign reserves, right? If you're going to fix your currency, you better have a big backup. And what's the big backup? I better have a big stash of dollars sitting around to protect myself, right? It's kind of like an insurance policy. But what that means is, once again, you're lending all of this money to the US. You're holding all of these dollars and getting very little return for them. It's great for the US, right? Once again, it's great to be the international currency, but many countries have really have better uses for their money than just lending a bunch of money to the US, right? The third option here is you could do what China does. China says, I want independent monetary policy. I want to pick my own interest rates and use stabilization policy. I also want fixed exchange rates. Well, can you do that? Yes, but then you're going to have to put limits on capital mobility. You're going to have to impose capital controls, right? So capital controls are basically restrictions on the movement of assets, and these prevent panic, right, or capital flight. So China has this very extensive system we'll talk a little bit about this tomorrow, of limits on how much capital you can pull out of the country. But of course, the thing is, if capital can't come out, it won't go in the first place. So in many ways, many investors don't save money in China, even though it's in many ways a very attractive place to save. But they're worried that if they put their money in, they'll never be able to pull their money out. So it weakens confidence in the Chinese financial system, and it reduces foreign capital inflows. It also leads to corruption. And we'll talk about this tomorrow, but China has a huge problem with corruption in its government. And, how do capital controls lead to corruption? Well, when you have capital controls, you basically have bureaucrats making decisions on what money can come in and out. And so it leads to a system by which people bribe or pay off bureaucrats to get the kind of things that they need. So one of the interesting things about the choice of capital controls is how few countries actually adopt this, right? I mean, you have China and North Korea and Iran, but for the most part, countries really don't like this option because it's very difficult to attract foreign capital if you impose capital controls, right? China, while it is able to attract some foreign capital, attracts much, much, much less than it would, except for the capital controls, right? China probably should be the world's largest recipient of foreign capital, but they're not, largely because of all these capital controls. So I'm sorry to move up and down, but this is the policy trilemma, right? Are you going to fix your exchange rate, float your exchange rate, or impose capital controls? That's basically what you have to do. Which countries decide to float? Well, they tend to be, the big countries that really want independent monetary policy, right? And they don't want to have to give up control of their domestic interest rates. So, the big countries tend to float. Who tends to fix? Smaller, poorer countries, those that have weaker financial systems, or those that trade a lot with one country. So, for instance, the Bahamas fixes to the US dollar. That makes perfect sense, right? Bahamas, their entire economy is tied to the US. There's very little value to them of having an independent monetary policy. For countries that are smaller and poorer, meaning they need to attract a lot of foreign capital, countries that don't have very strong financial systems. So in other words, the only way they're going to be able to attract financial resources is through foreign capital. And those countries that trade a lot with one big country, they're going to fix, right? They're going to tend to fix. There are alternatives to the extremes of floating and fixing. Some countries try to do managed float, right? Which is they let their currency float within a small range, but intervene to try to keep it from moving too much. Some countries have also gone to a monetary union, right? And you can think about a monetary union as a fixed exchange rate system, right? The euro is a fixed exchange rate system. Every country is fixing their exchange rate on a one-to-one basis. So a euro from France is worth the same amount as a euro from Germany. And if you think about how the euro got there, it was a transition, right? That Europe was in Bretton Woods, which is a fixed exchange rate system till 1971. Then they floated for a while, but then they moved back to a system of fixed exchange rates between 1987 and 2001. And then they transitioned that fixed exchange rate mechanism for the countries who joined the euro into the monetary union. The monetary union is a fixed exchange rate system, but it's an extreme, right? There's no possibility of devaluing, right? And it makes it very difficult for you to adjust your prices, right? So it is a real commitment to having exactly the same monetary policy. And as we talked about with the European debt crisis, that's both a good thing and a bad thing, right? In many ways, it provides huge advantages to Europe, but in other ways, it creates problems, right? Because it doesn't really give them the flexibility to respond to things like an international financial crisis. So um, let's, sorry, if you want to see what most countries do today, this is just a look at the different kinds of exchange rate regimes that different countries follow today. There's countries that have dollarized, and by dollarized basically means they just use US dollars. They just use US dollars as their currency. There's a currency board. A currency board is basically what the Bahamas does. Bahamas has its own currency, the Bahamian dollar, but it's actually backed by a US dollar. So every Bahamian dollar is actually backed by a US dollar. That's what a currency board is. So it's essentially like using US dollars, but it gives you some ability to have your own currency. A soft fixed peg, right? To be honest with you, there's very subtle distinctions between these, but a soft fixed peg would mean that you peg or target your exchange rate, but you have a lot, you let it fluctuate a lot around that. Or a target zone, which is a more narrow band for floating. A crawling peg, which means that you fix your exchange rate, but you actually adjust it in a predictable way. Managed float means that you're pretty close to floating, but you jump in extreme situations. And then a pure float means you never jump in. I'm not that interested that you know every single one of these. To be honest with you, the main point I'm trying to convey here is that countries can kind of do different sorts of things, right? They can, you don't have to do the extremes of fix or float. You can actually try to do some intermediate cases. And many countries try to do these intermediate things. All right. So just to kind of review here, when a country fixes your exchange rate, you lose control over your monetary policy to do anything else, right? You cannot have independent monetary policy and fixed exchange rates and capital mobility. Also, countries other than the US with an overvalued exchange rate can't maintain that forever. This is the problem of currency crises, right? So you can't maintain an overvalued exchange rate forever because it's likely to lead to a currency crisis. On the flip side, it's difficult to maintain an undervalued exchange rate forever as well, because it's going to lead to inflation. So, having an overvalued or an undervalued currency, it doesn't seem to work very well in the long run, because it's going to lead to situations where eventually you're going to have an economic crisis of some sort. The final implication that I want to talk about today is just that the US is special, right? Whenever you talk about the US dollar in the international financial system, you have to recognize that the US is unusual. Other countries fix to the dollar and do the dirty work for us. While the US floats, while the Fed spends very little time managing the value of the US dollar, other countries spend all their time managing the US dollar. And that's a huge amount of work and a lot less flexibility for them, but it's a lot more flexibility for us. Other countries hold trillions of dollars of US foreign reserves, essentially making big loans to the US. And this is one of the reasons why we have these big trade deficits, is because the US finds it so easy to borrow from other countries. They give the US flexibility to run huge capital account surpluses and trade deficits. And so, one of the things that we see is that there's an article here that I posted in your handouts about the love-hate relationship that countries have with the dollar. And, this is definitely true, right? Most countries love the dollar in many ways because they feel like they have to love it, right? They have to hold lots of US dollars to be safe. But on the flip side, they hate the dollar because they hate the fact that they have to make all of these loans to the US. And they hate the fact that whenever the Fed changes policy, other countries have to kind of play along, right? So the US kind of makes decisions about what's good for the US, never thinking about other countries, and then other countries have to kind of adjust accordingly. And so many countries have talked over and over again about, well, what would the alternative be, right? Could we create an alternative to the dollar? When the euro was started, one of the reasons that European countries engaged in the euros, they thought, oh, maybe the euro could be the alternative to the US dollar, right? And so that would be, in other words, the euro might become the international currency, and the European countries could experience all the benefits of having the euro be the international currency. But that hasn't happened, in part because of the European debt crisis, and also the fact that, quite honestly, the euro doesn't really work that great for many reasons that we haven't really gotten into this in this class. The euro is as much a economic union as it's a political union, and that the political union is frayed, right? It doesn't work so well, and so it has really made the euro a less attractive way to save your money. And I'm not saying that people don't that foreign investors don't hold lots of euros; they do, but it still doesn't rival the dollar in terms of its attractiveness. Now, many people have said, well, what about the Chinese RMB? What about the Chinese currency? Could it be an alternative to the US dollar? The problem is the Chinese RMB, with all these capital controls, once again, it doesn't make it very attractive to hold RMB, right? You don't know if you can actually buy Chinese RMB. And if you do, you don't know that you could turn it into dollars or another currency whenever you needed to, right? So I just want to show you this article here. Oops, this is not the article I wanted to show you. What did I do with it? Well, shoot. I'm sorry. Oh, I know where it is. Apologize. Didn't want to show you an article. I just wanted to show you this. This is out of The Economist magazine here, just the last week or so. But this is looking at debt securities outstanding, the top 5 issuers of debt. And a lot of this debt is held abroad, right? So there's a couple of things to notice here. First off, look at, of all the debt in the world, how much of it is issued by the United States. And this is a function of the fact that the US borrows too much. But it's also a function of the fact that the US can borrow so much, right? I mean, people buy US debt. They like to buy it. The US, because it's an international currency, is an attractive asset for people to hold. Now you notice that China actually is becoming more attractive, right? China gradually is becoming a more attractive way to save your money. But the fact is, China is still relatively small compared to the US. And that is because it's so hard to get your money into China because it's so hard to get it out. One of the interesting things that's happened here during the pandemic is notice that the US government, or the government bond index for China, has actually remained pretty stable. Chinese government bonds have actually looked like a good investment. They haven't fluctuated all over the place. You compare this to other emerging market economies who saw big declines in their bond markets, right? Lost a lot of money. So you would think that this would make China, a much more attractive place for savers to put their money, and that a lot of money would have flowed into China, but it hasn't. And once again, it's because of these capital controls. And then I think it's also, in general, just kind of a general lack of transparency about what's going on in the Chinese financial system, what's going on in the Chinese economy, what's going on in China with the coronavirus, right? China's not the easiest place for which to get data that you find believable. And so that really leads us to the discussion tomorrow, right? We're going to talk about the Chinese financial system tomorrow. I think it really makes an interesting case study to kind of compare and contrast with the US. And also because the Chinese financial system is just a huge part of the world financial system. So we will pick up there tomorrow in day 17. For now, hope you're all well, be safe, Talk to you soon.